All right, Foued says, hello, thank you for the session. What is the best strategy on low volatility environment when premium dries out? Are credit spreads more appropriate? Now, I saw your question, Foued. I wanted to put it into Andrea's question, but I'd gone too far with that discussion as needed to be covered for that question that came in. The VIX here, we're down in this level in 13s. We saw some of those hit. This was in 2021. Okay, so back in that 2021 range before the hysterics that were 2022. And we know what happened in 2020 leading up to that. And then back here, this was in the 2018 range. Still some good spikes, though. We remember that disastrous end of October, November, December of 2018. Some spikes in 2019. And then back in the beginning of 2018, before the end of the year, we were looking pretty good. And back in 2017 is when we were seeing 9s. I think we've dropped as low as maybe 7, somewhere along those lines. You know, a long time ago. long time ago. Now, what I'm going to say is going to seem counterintuitive in the sense that in the beginning of the conversation, and it's going to be a separate webinar, of course, post it as an archive of a separate webinar. We talked about the short strangles and the risks of the short strangles. Foued's question, what is the best strategy in low volatility environment when premium dries out? Are credit spreads more appropriate? Right away, someone's going to say, no, why would you trade credit spreads with low volatility? You're getting no premium. But remember the structure of the short strangle or the iron condor. Okay, directional bull put credit spread as well. Sorry about that. Or directional bear call credit spread. What do you want to have happen in most of these strategies? You don't want this volatility spike because of unexpected market movements. You don't want sudden drops in volatility because the market's moving up unexpectedly quick. You want nice and stable, neutral, bullish to stable, bearish to stable, because you're starting off out of the money. Do you get better volatility or get better premium, when volatility's up here? Absolutely. Is it worth it? Because the volatility is that high for reasons of market fluctuation, or when this starts to go up, the fear gauge in the market is extraordinarily high to sense other fluctuations. Where I'm going with this, Foued, is that one thing I wanted to mention to Andrea's question in the beginning is that if this starts to keep petering out and sort of keeps hovering in this 12 to 15 range, it's going to be the perfect time. And I hate to say it because I'm not going to trade it. And I don't like taking infinite risk, and I don't like advising to take infinite risk. But that might be a good time for short strangles, iron condors, maybe iron butterflies. Well, everyone's going to say, how can that be? The implied volatility is low, so you're not getting enough premium. Yes, but you're not expecting large sudden spikes and swings in the market either, so your success rate is likely to go up. You know, the volatility is going down because the market has been going up. Maybe Andrea has a point, thinking that the stocks are going to level off, stabilize, or go back to that range and maybe stay in that range where IWM is at 175, SPY is right around 400, or SPX is right around 4,000, but then it stables off, or we see a melt-up market, which is kind of what we've been seeing. What is a melt-up market? Well, that's where you have periods. Let's go to 3 months again for SPY. Here we go. So this is sort of a melt-up market, isn't it? We didn't suddenly jump from 385 3 months ago up to 430. That's a 50-point move. It's pretty respectable. All right, 45. But in any case, we melt up here to 395, we have a little hesitation. We melt up here to 410, have a little hesitation. Melt up here, reasonable hesitation. Some swings here. Melting back over 2-week period, a little hesitation. Melting up. Something in a neutral position from here on, maybe such as iron condors. Yeah, a couple little spikes here and there. Or the short strangles, But we saw Andrea got caught with a short strangle on IWM. But even though volatility is lower and premiums are drying up, this is the market you want for those kind of stable structures. Let's do a custom one. I want to go back to 2021. After, all the election hoopla, after all the pandemic, major pandemic, of course, we're still dealing with pandemic issues. But what was 2021? Let's go to 1/4/2021 to December 31st. There we go. Other than that big dip, I forget what this was for. That wasn't now, because this was much later in the year. That was in September and October. But what did we have? Melting up, hesitation. It's a 10, 15 point hesitation. That's bad, but melting up for almost a month, hesitation. Melting up, hesitation. Jump, but melting, hesitation. Melting, hesitation. This time frame was a good time for those iron condors and short strangles. There was movement upwards and there was movement downwards, but it kept doing this melt up, and then this was disastrous, and we shot back up. So yeah, the bear call side might have been violated here, as Andrea's short call was violated in a short strangle. But this range here is more of the market that you want to see for credit spreads, bull or bear, because you're going further enough out of the money even to withstand this. But I would have followed the trend and been in bull put credit spreads, and I was during this time frame. Iron condors might have worked out well too. But everyone's saying, but you're getting so low premium. The implied volatility isn't what it was back in 2020. Well, think of the image of the structure. Is an iron condor a bull put credit spread or a bear call something that I wanted to be trading during 2020? Well, yeah, there was a lot of times where you get high premiums and you might have been able to sustain the harsh movements, but we all know what it was. Extremely volatile up and down. There's a good melt up period in here where premiums were extremely robust, but then you got hurt. And then you got hurt. Well, you're getting hurt here on the bull side. Or bear side, my apologies. You're getting hurt here on the bull side. Back and bear side, bull side, bear side. It's just taking you out both ways if you're in an iron condor. But this range here is pretty good, but you probably would have gotten taken out on the bear call side. Premiums were robust. Here, the same thing. Here, you've been taken out on the bull put side. Here on the bull put side. Here on the bull put side, So slow and steady wins the race. And a lot of investors who call me tell me, look, I'm not looking to make $1 million. I just want to hit singles and home runs. That melt up market that we saw in 2021, and maybe the melt up market we're starting to see right now, possibly now that the interest rates have ebbed, the debt ceiling agreement has passed, and some other things, some negative things are still going on, but some other positive economic things are going on. And that's the sentiment that you want for credit spreads with good probabilities. I mentioned 80, 85% or higher, iron condors or maybe the short strangles. No, the return's not going to be what it was at the beginning of 2022 or through 2022 volatility. Of course not. But you're also not managing 50 to 60% of your trades because everything is moving against you one direction or the other. Nice, steady, melt up market. Okay, 2022. You saw the presentation we did there. Even if I did bear spreads in the first 6 months, because of the shifts, that was in that 3% per month possible. We showed just what would happen with 85% probability out of the money 2 week out bear call credit spreads. You'd be down 18%, 19% in your portfolio in the first 6 months, even applying management techniques. If you just did bull puts, big movements up, movement up, this took out the bear calls enough. In this case, there's a big movement up here, but you were down, I think it was 63% of your portfolio with the bull put credit spreads during that first 5 or 6 months. But if you followed the market sentiment tool, and when you saw the bearish sell signals, you did bear call credits, and we saw the bullish buy warnings, you did bull put credits. With one little hiccup here back in June, I think it was around here, you were still able to achieve the goals that you wanted, but you had to be nimble and change with the market. Now, it's important that I mention that and I sneak that in because just starting the other day, it went back to neutral. How about that? I started to see some sell warnings Yeah, it was last week, 6-6, sometime around there. But we started to see sell warnings and the number of bearish warnings come up because the market's been going strong recently and we've been moving up. I'm starting to watch this again to see if there's going to be a directional change in the market sentiment where we might see a short-term bearish hesitation, pullback, or if it's going to be more defined. But if it's just a slight hesitation, that might be pointing to the indication Foued we're more in that melt-up market that we started seeing, that we saw for most part of 2021, which is a great time, even though premiums are lower, but your success rate will probably be higher for good probability iron condors, bull put credit spreads, bear call credit spreads, and other spread strategies. But also, with melting up, bullish strategies are still going to be in vogue. Covered calls, married puts, collar positions, bull call debit spreads, diagonal calendar call spreads, I should say. But I just wanted to bring that up because I'm watching that now because I started to see some sell warnings come up the other day. The market has been moving up. Some positions have been moving up very well. Video, it's an older one. I got so much on my, I got some other presentations that desperately need to be wrapped up in the next 5 days or so. But if you go in and you look at double-edged sword, this is from 8 years ago. If I made this presentation today, it'd still be, okay, it wouldn't be an hour and 23 minutes long. I could sense it down to 30 minutes or make it 2 parts, honestly, Foued. But it'd be 90%, 85%, 90% the same content. The other 10 or 15% would be showcasing the risks of doing those new, which is discussed in this one, but not to the extreme that we saw for 2020 and 2022. But the risks of trying to chase credit spreads and iron condors because of the increased implied volatility and higher premiums, that it leads to more losses over time. That you're managing more positions, I should say, in that case. So that's just another way. Implied volatility, the double-edged sword. I know a lot of investors and a lot of gurus out there say, oh, you only want to sell options when implied volatility is high. Yeah, but you got to pay attention to the structure. Why is the implied volatility high? Fear in the market. Because there's fear the market could shift direction to the downside. I don't want to be in a heavy bullish position just for extra premium. I'm asking to be wiped out on that trade. And that's just like trading a bear call or a bull put credit spread or an iron condor around earnings. Hey, I can go 10% out of the money and get this great premium because implied volatility is increased. And some of the times you're going to be right. And some of the times you're going to be in the position that drops 20 to 30 points. We saw a couple of this week. We also saw some go up 20 to 25% on the blue. Carvana. People were probably trading bearish spreads on Carvana thinking it was heading for bankruptcy. And they come out and say, nope, earnings not going to be that bad. Boop, goes up 25%. Those bear calls are wiped out. You're near 100% loss of what you entered in the trade. And that wasn't even related to earnings. That was something unexpected that came out saying, nope, not going to be as bad as we expected. We're doing the right thing.